Welcome back to our mini-series, Profiting with Index Universal Life. In our previous video, we looked at the basic index crediting mechanics and how we can make a sizable return on our cash value. In today's video, we'll be looking at one of our premier carriers for Index Universal Life called Securian. Securian, also known as Minnesota Life, has a unique IUL product that gives us superior returns and benefits that I don't see every day with other carriers. So let's go ahead and dive into some of the product's unique features and its impressive index crediting returns so we can craft the most useful and profitable policy. So let's check it out. By the way, welcome to the channel. My name is Joseph Gutierrez, and this is Covered in Compounding. Click like and subscribe to the channel where we talk about how we can use high cash value life insurance as a foundational asset to build our wealth over the long run. So first, let's take a brief look at the health of the carrier itself, Securian, and its ratings. So Securian has a COMEX score of 96 out of 100 with an A+ rating from AM Best and AA rating with Fitch. Securian Life Insurance Company holds 1.6 trillion in insurance in force and assets of 73.5 billion as of the end of 2023 numbers. Securian, aka Minnesota Life, has been in business for 140 years and serves 24 million customers and climbing. It's been a consistent holder of wealth for families over the country and has stood the test of time. So next, let's look at some key unique features that I particularly like for my clients. Now, for one, we have the ability to blend our designs. In Securian's case, we can forex our term rider compared to the base of the contract with a minimum of $100,000. The basic explanation of blending is that we introduce supplemental term insurance as a rider to the policy, which contributes to our total death benefit. When we blend our policies with a term rider, this allows us to shuttle more of our premium dollars towards our cash value and minimize our policy costs. So instead of allocating, say, $500,000 toward the base permanent portion of the IUL contract, which would be more expensive, we can instead blend $100,000 of permanent base and $400,000 of term insurance tacked on for the full $500,000 death benefit. This, coupled with perhaps an increasing death benefit design, means significantly more of our premium dollars ends up going towards cash value and less towards the insurance policy costs. Now, this makes a profound effect on near-term and long-term cash value as well as our total death benefit. Remember that our cash value grows, so will our death benefit over time. Now, blending supplemental term is not something that most carriers even allow. That and most agents tend to shy away from it, even talking about blending. Almost always the reason is why is because it greatly affects their commissions. An agent's commission is almost entirely dependent on the base amount of the policy. Unfortunately, this is fairly common in the industry where agents will put their pocketbook before their clients. All I can say is here at Covering Compounding, our philosophy is that we'd rather give our clients the best policy we can, notwithstanding the size of the commission. We end up more than making up for it with happy clients and word of mouth. Again, though, blending our policy is very important, and we may go into more detail on this in the future. Needless to say, we greatly increase and improve our cash value performance with a term rider addition. The next item is low cost of insurance in general. If we look at the base cost of the insurance and compare it to the rest of the industry, we see Securian as one of the lowest costing index universal life policies. This means that Securian runs their business so efficiently that they can significantly drive down their insurance costs. This is true for the Eclipse product and what we'll be looking at later, their Nexus sponsored BGA 3 IUL product, which is built on the same Securian IUL chassis. Because Securian has some of the lowest cost insurance rates in the industry, it can greatly increase our potential cash value over the long run as we don't have that additional policy cost dragging our cash value profits down. Couple this with the blending of a policy design, we avoid unnecessary costs almost entirely and reap significant increases in our available cash value, which we will also see later in the video. Another great perk with this carrier is that we get a bonus credit in years 11 plus of about 56 basis points on our cash value. Now, this may not sound like a terrible lot, but it is essentially free money given back to the policyholder. When we look at long-term illustration projections, we see this bonus credit covering most of our insurance costs in later years, adding to our total cash value. This bonus, coupled with high accumulated cash value, is one of the big draws that many of our clients have towards Index Universal Life. It helps them in the near term with the line of credit against their cash value, and also for retirement by granting them the ability to give themselves income. And unlike the everyday 401k plan, this income is tax-free via policy loans. Having that extra bonus crediting coming in year after year, covering most of our policy costs while we're pulling out tax-free income is a huge plus. Now, it is important to remember the bonus of roughly 0.6% is not guaranteed. However, in speaking with many of the representatives at Securian, no one can point to a time where the bonus wasn't given. It's kind of like the dividend in a whole life policy. It's not guaranteed, but year after year, it shows up in practice. There's some other notables that I kind of want to list here on the screen here. For one, we also have what's called partial crediting. This pertains to how we receive index crediting, even if we take a cash disbursement or a fixed rate loan. With other carriers, they remove the crediting potential on the amount dispersed or pull from the indexing account. But luckily with Securian, they still finish off the segment and give you that partial crediting from the index. This does make the policy more flexible and enhances our future cash value. Next, there's the availability for a 90-day interest-free loans. This is a pretty cool feature where we can borrow from our policy, and if we pay it back in the 90 days, we don't incur any interest expense. We're still indexing in the background as well. I could see this especially beneficial if you're a small business owner needing to access quick cash. This could come through in the clutch, as they say. If you hold longer than 90 days, the interest is 5% per year. Additionally, the standard index policy loans are 4.75%, which is pretty darn competitive. We did a past video on the different disbursement options in Index Universal Life. Link in the description if you need a refresher. Another notable perk is the Income Protection Flex Agreement. This is a nice estate planning addition that many of my clients appreciate. This is where we can split up the death benefit and have it granted as a partial lump sum and the other portion as an annual payment up to 30 years. For some clients, giving a $2 million tax-free check to an 18-year-old grandchild may not be the greatest idea, so this gives the policyholder some peace of mind knowing that the payment can be broken up over the long run. Also, because the death benefit is paid out over multiple years, it also allows for more possible death benefit to be given to the beneficiary over that time period as well. Traditionally, people accomplish this with more involved, costly, or family trusts, but nonetheless, it is a nice option at no cost to the policyholder. Now that we got some of the unique perks and notables out of the way, let's take a look at the index options. Okay, so now that we got some of the notables out of the way, we're going to focus in on one of their particular products with Securian, also known as the BGA. This is sponsored through Nexus. This is the Balanced Growth Accumulator Index Universal Life. One of the reasons I like this particular index more than some others is that it does have some unique indexing choices with heightened participation rates and volatility controls so that we can maximize our gains over the years. So we'll focus in here on the screen for the indexing account options. Okay, so when we put together an illustration for a client, one of the pages is going to show the different indexing option choices that are available. Okay, like most carriers, there is usually an S&P 500 type index, which oftentimes has a cap rate. Now, if you remember from our previous example or a previous video, we would like to avoid cap rates if we can, because it is an upper ceiling on our potential earning capacity for that particular year, for that particular option length there. Well, what we're going to be focusing on today is going to be the S&P PRISM Index and the SG Global Alpha Index. All three of these right here have an uncapped feature, so we don't have to worry about any kind of caps cutting off our potential gains. Plus these nice participation rates, okay? Usually when we talk about index universal life, I like to say that the average is somewhere in the 6 to 10% range, right? Some years we're going to have a great year, other years it's going to be a negative on the index, underlying index, which will translate into what we often call a 0 year. So we didn't lose any money in our cash value, but we didn't gain any either. Usually the recovery periods thereafter swing to the upside significantly, but nonetheless, usually I like to forecast usually about 6 to 10% on average over a 10, 20, 30-year period. Now, when we focus in on these particular options, I think we're going to do better than that average 6 to 10. If we look at our first index choice that we're going to be focusing in on is the S&P PRISM, the 1-year S&P PRISM Index. So right off the bat, we see that it's uncapped. It has a participation rate of 100%. And we have this interesting index declared rate allocation, okay, where we have this 215% index rate allocation. So the way Securian does this is essentially an additional participation rate. Okay, so how the math works out, if we do like a quick example, if we get a 10% year in our underlying index, what we would do, we would multiply by the participation rate. In this case, it's 100%, so it translates to 1.00 times this index rate allocation of 215% or 2.15. Okay, so when we do the quick math on that, we should be credited 21.5% on our cash value for that year. Okay, so remember, when we utilize index universal life and the call option underlying action for these indexes, we heighten our potential returns significantly, and it's all tax deferred. Okay, and we'll see that here shortly. Okay. The next option here is the Balanced Index Account 7. This is the 3-year S&P PRISM Index. So if you remember in our previous video, we utilized 1-year call options, and however that index did over that 1 year is what we would be credited at the end of that segment period. In this case, we're utilizing a 3-year segment, which allows us more time to acquire that particular crediting. Because it's a longer time period, we do get a substantially increased index rate allocation and or participation rate. So in this case, we have the 115% times 340% on that 3-year price action, or the end result of that 3-year price action for the S&P PRISM. Pretty powerful. Now the negative here, of course, is we have to wait 3 years. So a lot of my clients like to blend this with the 1 year or the SG Global, putting a certain percentage of their total cash value allocations. They could do like say 30% towards the 3-year PRISM, and then the other 70% split amongst the other account choices. It is up to them after all. But if you have a longer time period, and as far as your growth in the cash value, we can see heightened gains by utilizing this 3-year option. And the last one here that we'll touch on here is the SG Global Alpha Index. And we'll go into more detail here on these index choices in just a moment, but we can see that we're getting 105 participation rate and 205 index rate allocation. Okay, so that's the general math. And we notice here at the bottom, the maximum illustrative rate is about 6.5%. Like I've said in the past, 6 to 10% crediting rate is kind of the rate we like to kind of forecast as far as how an index universal life policy may do. That said, when we look at some of these different options here with the BGA product, we can possibly do quite a bit better than that and further enhance our cash value substantially over a 10, 20, 30-year period. Now, before we look at some of the crediting history on these particular index choices, let's go ahead and take a look at the S&P PRISM in general. So the S&P PRISM index is an index that allocates their funds across different asset classes. We have our equities, our bonds, and our commodities. Okay, so what's nice about this particular index is that it is managed on a daily basis. So how the index is balanced can change on a day-to-day basis depending on what's going on in the market. So for instance, if we have a bull market and the S&P 500 is doing very well, well, we may be allocated heavier towards equities. If we have a bear market and we have high inflation like we've seen in the last few years, well, we may be allocated more towards commodities and bonds as opposed to equities. What's nice is that it rebalances daily if need be, not every day, but it can rebalance on a daily basis so that we minimize our volatility and maximize our gains compared to if we're just in the S&P 500 index. This is why we can see significant gains compared to the traditional index. And we'll see that here shortly. Just want to touch on the SG Global. This is based on Société Générale. This is a French investment bank. And what's nice about this particular index choice is that we have global diversification across different markets, some of the Eurozone, Japan, and emerging markets, which have done pretty well over the last few years. We also have these AI powered forecasting tools, which allows the index to reposition itself, and it can do so on a monthly basis. So if we're looking to be exposed to the different gains that are going on in different markets, this SG Global Alpha Index does quite well, and we'll see that here. So let's go ahead and jump to some of the crediting history. Okay, so we can see here, this is the back to the S&P PRISM 1 year uncapped. And when we look at the compound average of that S&P index, the growth over, say, a 30-year time interval on the hypothetical basis, we would be making about 5% on the underlying index. But when we factor in all of that crediting based on the participation rates that are applied, we can see that we can actually get closer to 12%. Okay, if we look at different time intervals of a 10, 15, all the way to 30 year, we can see we're kind of averaging around 10 to 12% roughly as far as how the S&P PRISM index will do. Now, remember, there is some level of what's called back testing when we put these different index choices are put together. Now, for some IUL naysayers, they'll point to this as a negative, which doesn't really make a terrible amount of sense. But back testing basically means that when they're putting together a new index, looking to enhance returns for their policyholders and clients, they'll look at previous years and apply the same metrics that and participation rates and how the index is allocated to see if it would have done well in the 90s, the early 00s, the 2010s, and in today's market. Each of these markets had different interest rate environments, different bull and bear markets, and the purpose of back testing is to make sure that the particular index that we're putting together will do well in multiple instances. Okay, this particular index, I believe, was put together in 2018, and we utilize the same back testing methodology that all indexes are put through. Okay, so this is actually a benefit, not a bug, because if it can do well in different interest rate environments and different market environments, then it can do well in today's market as well. And we've seen that, okay, in the last 5 years, we've seen great gains. We have 20% year, 12, 4, 8, 1, 0 year. And if we average all that out, we're going to have fantastic gains, okay? So on average, if we apply it over a 30-year interval, we're somewhere around the 12%, which is significantly higher than what we say about 6 to 10%, okay? The illustrated rate is still 6.5% roughly, but nonetheless, we should expect much better crediting. This is the 1 year uncapped. Moving on to the 3-year, what's nice about the 3-year is that enhanced participation rate, where we're going to get uh, accented crediting back to our account here in the cash value. The negative, obviously, is that we have to wait 3 years before it shows up. So if we look over these intervals here, we can see these huge numbers, 108%, 54% gains. Well, we do have to break that up over a 3-year period. So if we divide that by 3, we'll see kind of like a annual basis there. But what's nice about what Securian does is that we can utilize what's called a DCA. So if you're in the stock market world, you'll recognize as dollar cost averaging. So what some index universal life carriers will do is that, let's say we're putting $10,000 as going towards our cash value account. Well, they'll utilize that $10,000 and they'll say, okay, this is January 1st. We're going to put a January call option together and we'll wait till January of the following year. So let's say 24 to 25 January. Okay. If we have a bad month in December, it could wipe out the entire that entire segment, and we may get a 0 year. What's nice about a DCA strategy is that we're going to break up on a monthly interval that totals, say, $10,000. So for January, February, March, we're going to have a 12th of that particular option budget. So let's say it's $800 a month for the 12-month interval. We can break up our gains across those 12 months so that we don't have any potential swings knocking us out completely. We kind of DC our dollar cost average, which is particularly nice. It's an option. You can do one or the other, which is a nice addition. And with putting together the 3-year uncapped, I recommend the DCA strategy. And we'll see that here shortly as well. So like we can see, we're doing quite well. I mean, it says 17% on average with all that participation rate. Obviously, we have to wait that 3-year period, but we're looking at 16 to 17% annual return on average. Okay. Next, we'll look at the SG Global. Okay, so we're being exposed to the global markets here, the Eurozone, the Asian markets, and other emerging markets, and we can see very good gains over the last few years. So usually when emerging markets are doing well, the U.S. may not be, and vice versa. It's always nice to have a different allocation with your option choices here. So what some of my clients will do, they may put, I don't know, 30% allocation towards the SG Global Alpha Index, and then they may put another 30% towards the 1 year, and maybe the other, I don't know, 40% over to the 3-year uncapped S&P PRISM. Okay, so they're able to kind of split their risk among different index options here, and possibly do better than putting it all into one bucket. Okay, and that is the option for the client. Now, if we do want to look at some of the segmenting information, which is always kind of helpful, we can kind of go a step further. This is only available to the advisors, which I am myself with Securian, on the insurance advisors. And we can see kind of some of the different segments that can be set up. So the segments are done on a monthly basis, and this is an example of dollar cost averaging over each segment, okay? Over each month of the last, in this case, last year, we're illustrating, and we can see our crediting. So how the index grew over the 12 months, so from 2024 in March to 2025 March, we can see how the index growth rate was 3.8% and how our segment crediting is substantially higher at 7.6%. So the money that we put in that particular segment, if we're doing dollar cost averaging, that's what we'll get, and then it gets re-rolled again for the next term period. Okay, so we can see how that segment crediting has done on a monthly basis, which is quite strong. We can also see that for the 3-year PRISM index. Okay, we will have to wait 3 years, but we can see how the segment crediting is particularly strong as well. And then lastly, for the SG segments here. Okay, so we can see how the global indices and global exposure has done quite well. So we can always hedge our risk and grow more effectively with this particular product. Thank you for watching our short video here on the Securian BGA product. We went over some product specifics and perks and notables of the product, as well as the various index and option choices from the PRISM 1 year, the PRISM 3 year, and the SG Global Alpha Index, and how we saw that we can possibly perform much better than the average 6 to 10% average rate of return in a index universal life policy. Securian is one of our better products out there on the market that allow for heightened gains and overall low cost and low policy fees, which makes it one of our top carriers that we like to recommend to our clients. In our follow-up video here, we'll look at our next carrier, Allianz Life, and then we'll also dedicate a video to blending and why putting together a specific index universal life policy around blending and maximizing is so important to your policy's performance and overall longevity of the policy and gains as far as income and retirement and all those tax-free benefits that we like with index universal life. Once again, thank you for watching. If you are interested in putting together your own policy, whether index universal life, whole life, or annuities, feel free to click the link in the description. It'll take you to our webpage where you'll see much of our information. On that page, you'll see a link to book now where you can sign up for a free online consultation. Now, during that online consultation, we'll go over some of your financial goals, your background, and what a policy could possibly do for you. We also do free policy reviews. So if you have a policy through another agent or a different carrier and want to see how it stacks up to possibly a better design, we will put one together and see if we can possibly improve your situation so you can have the best policy with the most usefulness as possible. Again, thank you for watching our video. Click like and subscribe, ring the bell, leave a comment, and I look forward to seeing you on our journey towards financial independence utilizing foundational asset. Until next time.